Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. The topic of inflation has come up again, and we're recording this on Thursday morning, and there's some interesting data that came out today about the rate of inflation year over year, still really high, but month over month might be a more important metric to look at. So I did want to dig into that, and to do that, I asked John Quast to join me. John, how are you doing today?
Doing very well, Travis. Thank you for inviting me.
And before we get too far, I do want to ask you to subscribe to Rive Investing. It really helps out the show. And John has a new YouTube channel as well. What is the handle there, John?
Working Capital JQ.
And he's got a lot of really great content out there. I'll put a link in the show notes as well. But I wanted to share some of the data that came out today because I think it really shows a changing narrative in the markets and the way the Federal Reserve might be thinking about interest rates. Here is the inflation data that was released today. This is year over year, so 12-month percentage change in the consumer price index. And they break it down into four things. This is all items, 6.5% inflation. That's going to be the headline number that you probably see in news articles. Food inflation is actually really high, 10.4% right now. Energy is 7.3%. And then all items except for food and energy is 5.7%. One of the reasons that we take out food and energy is these are commodities. So they don't quite play by the same rules as things like labor or services. We've seen over the last year, energy prices can double and then can fall back down again. So that's one of the reasons that you use a lot of these exclude item X numbers. Anything you want to add there, John? Because I think this is something we kind of think about, but don't necessarily talk about as individual stock investors.
I love, Travis, the point that you made before we started recording here, and that is that many of the headline numbers are looking at the year-over-year data. And as investors with companies, very often they point out their year-over-year numbers, but when we are analyzing those things, we're really looking at some of the quarter-over-quarter trends more than anything, because the year-over-year data can sometimes mask what is happening recently. And so to your point, the quarter-over-quarter numbers here for inflation looking better than some of the year-over-year headline numbers would have you believe. And that is really important if you're trying to pick apart where are we at right now? Not where have we been over the past year, but where are we at right now? The month-over-month numbers may be a little bit more telling about the direction right now.
Yeah, and this is a really nice chart that I often look at from Trading Economics that shows exactly what you're talking about right there. June was really the inflection point. I think I have been tweeting about this for a few months now, but when you look back at the consumer price index and the actual index itself, the rise in that index kind of stopped or stalled out in June. And you can see if you just look over the last 3 months, we're in a deflationary environment. So I'm not saying that we're going to have deflation, but I am saying that I think not only the narrative for the Fed is going to change. It's not going to be, hey, we're going to raise interest rates as far and as high as we need to, and we're going to sound really strong. Now it's going to be, okay, inflation is something has clearly changed, and we're going to have to adapt to that. Now the question is going to be, do we want to sink the U.S. and potentially global economy into a recession to kill inflation and potentially go into a deflationary environment? I think that's going to be the question that the Fed is going to have to work with. And I just want to flag that the reason you don't want to be in a deflationary environment is that's really bad for the economy, because now consumers expect that prices will be lower in the future. So let's say you're looking at buying an automobile. That's let's say a $30,000 purchase. You say you could buy a $30,000 automobile today, but you could get the same vehicle for $29,000 a month from now. What are you going to do? Well, you're going to wait. So that's the reason that we actually want a small amount of inflation over time, because you want people to spend money and keep the economy going. So that's the context there. This is the other chart. This is core consumer prices. So it takes out some of those numbers. And then I have also seen today, this was on CNBC, consumer prices fell 0.1% in December. That was apparently in line with estimates. But I've seen data showing that if you take out things like rent, which is, again, doesn't quite follow the same trajectory as a lot of these consumer prices that are going to be changing on a month-to-month or year-to-year basis. Rent is going to lag a really long time. So if rent went up 3 months ago or 6 months ago, maybe you didn't renew your lease until last month. So that's going to increase. But so basically, if you pull rent out, apparently inflation is a negative 0.6%. So that's actually now getting to a point where, goodness, we're actually prices are coming down pretty quickly. And so I know that we don't want to kind of play the Fed. The way that we invest is picking individual stocks, trying to put market tailwinds behind us, buy great companies that are misunderstood by the market. But the context that I wanted to put here is if we're over this inflation, oh my gosh, inflation, that's what we're worried about. If we're over that phase of the market, how does that change the way that businesses operate and the way that you think about investing? Because I think one of the things I have been talking a lot about is companies that look really cheap. And maybe now if we're coming out of an inflationary environment, there's going to be some tailwinds behind them. I don't know. But what are your thoughts?
I think one of the interesting things to consider with this is how many companies out there have paused certain things that they're doing, certain initiatives, certain spending, or especially in the business to business space, maybe not renewing some of the contracts that they have for software or what have you, because they were simply waiting to see what was going to happen with the economy. They're not necessarily hurting for money. They're just not sure if they're going to be hurting for money. And so they're waiting for some of these numbers to shake out. And now they are shaking out in an interesting way. I forget who says it, but supply and demand dynamics always adapting. And it's very hard to predict how they're going to adapt. And I think that is probably what we're seeing right now. So many people forecasting this and that. And now, to the counter expectation of a lot of people, the deflationary prices on a month-over-month basis. And so all that to say, yes, I think that things are calming down. I think that's what the data here shows in the most recent CPI report. Things are calming down. And when things calm down, that brings enough clarity that businesses can start making more informed decisions and being very proactive. And so I think that you will start to see that maybe at the end of the first quarter or into the second quarter, you're going to start seeing these businesses saying, we know where we're at and now we know where we're going.
Think about some of the areas in the economy that are really weak right now too, like housing. And I think we're probably headed for a rough patch in the auto industry as used car prices come down and more new cars hit the market and there's more availability. One of the things that I think is interesting to think about, given where we are today, is price anchoring and the mentality of over the last year. If you were looking at a home and you looked at a home a year ago and you could get a 3% interest rate, and now you looked at the same home and you were looking at a 6% interest rate, it's like you have sticker shock. Oh my gosh, like this got so much more expensive. Now we can't afford this house, or the price has to come down. There's all kinds of downstream impacts. That's kind of ground the housing market to a halt. Some of the same impacts are going on in the auto industry where people are just paying whatever is necessary to buy an automobile. I mean, we're sort of in this case right now. We need a bigger vehicle for a growing family. I mean, goodness, I would love to not pay over sticker for a vehicle or exorbitant used car prices. But what choice do I have? Well, if let's say in 6 months, these trends continue and the Federal Reserve not only stops raising interest rates, but maybe even starts lowering interest rates. And I will note that the yield curve is inverted, meaning that short-term interest rates are higher than long-term interest rates. And this is one of the reasons why, is that you raise interest rates and there's two potential impacts. You raise them too high and now you cause a recession, which causes you to lower rates, which is one theory. And the other is you raise them to kill inflation. You've now killed inflation, but the economy isn't hurt. So now you need to lower rates to try to drive prices higher. So that's, I think, the best theories that I've heard is that rates are going down in the future when we're talking like 3, 4, 5 years down the road. It's just that they're probably not going down in the next 6 months. So what happens to the economy over the next, let's say in summer to a year from now, when somebody goes and looks at a house and now interest rates aren't 6%, now they're maybe 5%. And you go, oh my goodness, that 6% rate, that's now what I'm anchoring on is 6%, and now it's 5%. This house looks really cheap. Same thing with automobiles. So I think that's another potential positive for the economy and is just a tailwind for all of the companies that we talk about and invest in. Is if houses are selling, if people are buying cars, it's good for everything. It's good for commodities. It's good for software companies. It's good for cloud services because that's the fuel for the U.S. economy and the global economy. So that's, I think, another kind of context that I think is important in this is that if we move from a rapidly rising interest rate environment to a potentially falling interest rate environment, that could be fuel for a number of reasons for the economy.
I think that sums it up nicely.
All right. We'd love to hear what you think about the state of inflation right now. I know this is kind of a confusing topic, and I don't want to hammer on it too much because there's a lot of noise with inflation, but it is something we need to at least understand why these macro impacts are happening, how the Federal Reserve impacts our investments, and things like that. So hopefully this provided a little bit of background. Thanks for watching. Please subscribe to Riven Investing and, of course, John's new channel, Working Capital JQ. I'll put a link to that in the show notes, and we'll see you here next time.